Hello, today we will discuss the important chapter of financial management, that is cost of capital. In economics and accounting, the cost of capital is the cost of company's fund, or in other words, it is a required return which is necessary to make a capital budgeting. So it's nothing but the procuring cost of the finance. I am Dr. Manish Dadij, and today we are going to discuss various types of cost, classification of cost of capital, cost of debt, cost of preference shares, cost of equity shares, methods to calculate cost of retained earning, and last step to calculate weighted average cost of capital. So let us begin with the simple definition of cost of capital. According to Milton H. Spencer, cost of capital is the minimum required rate of return which a firm requires as a condition for undertaking an investment. Another definition given by Ezra Solomon, the cost of capital is the minimum required rate of earning or the cutoff rate of capital expenditure. And as per the L.J. Gitman, it is the rate of return a firm must earn on its investment so the market value of the firm remain unchanged. So, all in all, cost of capital is the minimum required rate of return that a firm must earn on its investment to maintain the market value of its shares. Now we will discuss various types of cost. First, we will start from cost of long-term debt, cost of preference share, cost of equity, cost of retained earning. And if we give weight to all those costs, we get weighted average cost of capital. So individually, we all will take a look how to calculate all these kinds of cost. But before that, let us understand what are various types of cost. So the classification of cost of capital is very important to understand. The first one is explicit cost. It is the discount rate which equates the present value of cash outflow or value of investment. Thus, it is nothing but the internal rate of return which a firm pays for procuring the finance. So for getting the finance, whatever amount you pay, that would be your explicit cost. Second is your implicit cost. It is the rate of return which can be earned by investing the fund in any alternative investment, or it is also known as opportunity cost. So what is opportunity cost? Suppose if I give you two options to investment, if you give up the first option and go for the second option, the first option would be your opportunity cost. And the third one is very simple, historical cost. Cost which has already been incurred for financing a project by a company which is based on the past data is historical cost. The next cost is the specific cost and composite cost. When the cost for obtaining any specific financial instruments like equity, preference, debentures, bond, or for retained earning, that would be specific. And if we consider all together these costs, it would be composite cost. Next one is the average cost. When we give the weightage to the component of the funds to the total capital fund, it is average cost, often known as weightage average cost of capital. And the last one is the marginal cost. In a simple way, an additional cost which incur due to an additional unit of production or for production of goods or services, known as marginal cost. Now come to the first instrument, that is cost of debt. So in which we study what are various types of debt and how to calculate these debt. So we know that the debt are basically of two types, redeemable and irredeemable. What does this mean? When any instrument or the bonds or debentures redeem over a period of time, it would be redeemable, means you are able to get the interest and the principal amount over a period of time. It is redeemable. But if there is a no maturity date mentioned on that instrument, it would amount for irredeemable. In both cases, the instrument can be issued at par, at discount, and at premium. Now, question arises: what is cost of debt? It is an effective interest rate a company pays on its debt obligation. Suppose if you take a loan of rupees 50,000 from any person at the rate of 10%. So every month you have to pay 500 rupees if it is for 5%. Same in the case of irredeemable debt, the formula is KD is equal to I multiplied by 1 minus T. So here is the T is tax rate, I is annual interest rate. Let us understand with the help of this simple example. A company has issued debenture worth rupees 1 lakh, par value rupees 1000, coupon rate is 9%. Now we need to calculate the cost of debt if tax rate is 50%. So in that question, there is no mention of any maturity date. It means it is the case of irredeemable debt. So if we apply this formula, we get interest 9%, tax bracket is 50%, so multiplied 1 minus 0.5, so we get 4.5% is the KD or cost of debt. So when these instruments issued at premium and at par, we need to calculate net proceed also. So the formula would be same as earlier, but again we divide the total KD by this net proceed. So what is net proceed here? It is the total amount raised by the company by issuing the debentures. In case of par, the net proceed would be the par value. In case of discount, the net proceed would be the less than the par value. In case of premium, you know all about discount and premiums. In case of premium, it would be more than the par value. We can easily understand with this example. Company issues debenture worth rupees 1 lakh. Coupon rate is 10%. Here don't confuse that, the coupon rate is the interest rate. Tax bracket is 55%. Now you need to calculate cost of debt if debenture are issued at par, at discount of 10%, at premium of 10%. This is the formula, and I'll just explaining you like the major instruments so that you can easily calculate. So I interest rate is 10%, so 10% of 1 lakh 10,000. Tax rate already given in questions. Now the case of par NP, correct? So par value is 1 lakh rupees. In case if it issues at discount, so we deduct the interest rate from the par value. So 10,000 minus 1 lakh, so net proceed in that case would be 90,000. In case of premium, the net proceed would be 1 lakh 10,000. If we put all those figure in the above formula, in first case we get the KD 4.5%. In case of discount, KD is 5%, and at premium 4.09. Now come to the second case, when the debt issues at redeemable in redeemable form, means it can be redeemed over a period of time. So in question you will be given the time clause. So on behalf of that you have to identify like this is the case of redeemable debt. Now in the previous case we have assumed that the bonds are not maturing and thus are continuously going on. But when bonds mature after a certain period of time, it would amount for redeemable debt. So in that case the formula would be a bit different. So KD is equal to 1 plus par value subtracted by net proceed divided by N, further divided by the average of par and net proceed, or P plus net proceed divided by 2. No need to explain I, net proceed, par value and maturity period. So I already explained you will be given time. So on behalf of that time, you can easily understand this is the case of redeemable debt. Again, have a look of one simple example. A firm issues debenture of rupees 1 lakh but is able to realize only 98,000 due to 2% commission to the broker. The debenture carry an interest rate of 10%, maturity period is 10 years. Now I is like 10% of 1 lakh 10,000, par value is 1 lakh, net proceed because 2% commission you have already given to broker, so we have to deduct it and we get the net proceed 98,000, means 2% of 1 lakh 2,000 will be deducted from 1 lakh, so 98,000 would be your net proceed. And please remember that this KD is the before tax because there is a no clause of tax. So in the previous slide we studied that the KD after tax we have to multiply 1 minus t, then only you get the KD after tax. Now come to the second instrument, that is the cost of preference capital. The formula is D divided by NP. So please remember that the preference is a kind of shares. So on shares you always get dividend, not interest. That is why D divided by NP. Example, the company raises the capital of rupees 1 lakh by issuing 10,000 preference share of rupees 10. Dividend rate on preference share is 10%. Now what would be the KP at par, at 10% premium or at 10% discounts? So here is the solution. When it would be at par, so the KP would be the 10%, but the preference share issued at 10% premium. So in that case, DP means dividend per share, not per share, dividend price is rupees 10,000. Net proceeds, since it is issued at 10%, so 1 lakh 10,000. So here the KP 9.09. Same in the case of 10% discount. You can easily calculate with the help of this above formula. Now cost of preference capital, the formula would remain same. Have one simple examples. A firm has issued preference share of rupees 100 each, generating a profit of rupees 1 lakh, dividend rate 14%, and preference shares would be redeemed after 10 years. Here the flotation cost is about 4%, so the formula will remain same, except I. In cost of debt there was I, but here is D. Why? Because you get dividend on preference share, whereas you get interest on debentures. Same formula, same methodology, and the answer is also in this slides. So we will move ahead. Yes, this was the solution, so you can easily go through with that. This was the another example. Now the third instrument is cost of equity capital. Well, it is argued that equity capital doesn't have any cost since it is not legally binding on them to pay dividend. But this statement or argue is not correct, because equity shareholders are also known as the real owner of a company, and they invest in the company for two purposes. Number one, they getting the dividend, correct, if sufficient reserve, if sufficient profit is available with the company, or they have another chance like in market when increase the price of shares. So in two way they can earn. Further, if a firm is not able to meet the expectation of shareholder, the prices falls in the market. Thus KE, or the cost of equity, is a rate of return that the shareholder expect to earn on their investment. So these equity is basically of two type, without growth in dividend and with growth in dividend. With growth in dividend again divided into two part, in case of new issue of equity, and in second already existing share. Same in the case with growth in dividend, new equity and already existing equity. Now there are approaches to finding the cost of equity. The first, the dividend price approach, uh, uh, with the growth in dividend and without growth, that I already explained in previous slides. Now we go for the formula. Again, the formula is K is equal to D divided by NP. Here the D is dividend, NP is the net profit. Come to the numerical. A company offers for public subscription the share of rupees 10 at 10% premium. Commission cost here is 5%, dividend rate is 20%. So here D would be the 20% of 10, that is 2. The net proceed, how we going to calculate this? The 10% premium on 10. So what is the 10% of 10 is 1. So 1 plus 10 is equal to 11. So 11 is not your net profit. Again, you have given the commission cost, so you have to deduct the 5% of 11% and you get the net profit 10.45. If we put all those value in the above formula, we get KE, that is 19%. Take one more example. In case of no dividend growth, company share of face value rupees 10, market value already given in the question, that is 15. The expected dividend to be paid is 20%. So in that case, the D is 2%, again the 20% of 10, and the market value, correct, that is the that would be equivalent to your net profit. So here you need not to calculate any net profit, the market value is already given. So 2 divided by 15, your answer is 13.33. Now in second, the cost of newly issued equity. So in that case, the formula will remain same and we add the growth rate G. So KE is equal to D divided by NP plus G. G is the expected growth in dividend. So this would be a little tricky, and we can understand with this classical example. A company issues a new equity with equity share of rupees 150. Here the underwriting cost is 2%, and these are the history of dividend distribution. Now the expected dividend on the new share is 14.10. Find the cost of equity. So here are the figure are given for last 5 years, and this is the DPS, means dividend per share, in 2016 to 2020. Here is the formula, and how we can calculate this. D is 14.10 already given in the question. Net proceed is basically 98% of 150, or we deduct the 2% of 150, that is rupees 3. 150 subtract by 3, we get 147. So we can easily calculate D and NP. Now question arises, how to calculate this G, because nothing is given. So the expected growth in dividend, can we calculate from the table? Yes. So how we gonna calculate this? So please look at here. Rupees 10.50 is invested for 4 years and becomes 13.40. So for 4 years, so how we can calculate this G? So a 10.50 1 plus G to the power 4 year, and this after 4 year it will become 13.40, 1 plus G to the power 4, correct. If we cross multiply this, we get the G is 0.06%. So the easier way, again this is I already explained you. So in that case our G is 4. So we put this figure in the formula. So 14.10 divided by 147, and we add G 0.06%, and the answer would be 15.6%. Here is the one more example. You calculate it by yourself. The solution is also given. Now come to the last cost, that is the cost of retained earning. Well, the net profit after tax that is not distributed by the company to the shareholder is called retained earning, or in other words, the amount or the money which a company retains for the future prospect and not distribute among the shareholder, known as the retained earning. Such earnings are used for the companies for the future expansion, that I already explained you. But some people think that these earnings are free of cost and does not cost anything to the company. But this is not true. This is this is absolutely wrong. Why? Because when these earnings were given to the shareholder, then they would have invested them somewhere, and in turn they have earn on that investment. And the same concept we studied in time value of money, or the bird in hand is worthwhile two in the bush, or the money which you get now is more worthwhile than the money which you get after 1 year. So same fundamental principle is applicable here also for the retained earning. And it is also called as the earning sacrifice or the opportunity lost by the investors. Now, the adjustment required in retained earning. The money retained by the company is not equal to that given to the investor. Why? Because investor pay tax on the money given as dividend. In case if I earn some sort of dividend from the company, I need to pay tax. In case if company doesn't distribute dividend, company need not to pay tax. So this means if a company has 50,000 rupees, this is example, 50,000 rupees as a retained earning, and it decides to give it to the investor, then the investor will have less than 50,000 to invest, while the company will have 50,000 to invest. How? This is the short case study to understand this, and we definitely go through with that case study to understand the concept of retained earning. So come to this case study. The ABC Limited is earning net profit of rupees 50,000. The shareholder required a rate of return 10%. It is expected that the retained earning, if distributed among the shareholder, can be invested in security of a similar type, carrying a rate of return of 10% per annum. And it is further expected that the shareholder will incur a brokerage of 2% on dividend received to make the new investment, and the shareholder are in the tax bracket of 30%. Now what would be cost of retained earning? So the solution is in next slide. So here take a look. The dividend given 50,000, the tax bracket is 30%, so we deduct the 30% of 50,000, 15,000. After tax dividend 35,000. Brokerage cost is 2%, that is 700. So the net dividend available for the investment is 34,300 only. So this is basically money available for the investor or shareholder. Now expected earning given in the question is 10%. Correct. So the 10% of what amount? The net earning available for investor, that is 34,300. So their expected earning is 3,430, that is 10% of 34,300. Thus the expectation of the investor is to earn 3,430 from the retained earning, which in other words mean if the company is not distributed to the shareholder, the company need to earn 3,430 on 50,000. Therefore their earning would it can be calculated by 3,430 divided by 50%, so this would amount for 3.86. so this is the cost of retained earnings. So company must earn at the rate of 6.86% on 50,000. This was the main crux of this cost of retained earning. Now come to the last cost, that is weighted average cost of capital. The capital of a company consists of various components, as we already seen such kind of cost. Thus the company wants to calculate the total cost of capital. This total overall or the total cost of capital is calculated based on the weight or the given weightage of each component. So the total cost of capital equal to weighted cost of capital. Now there are certain steps we need to follow. First, they calculate cost of different capital component, like we have to calculate first KD, KP, KR and KE. Then according to question we have to assign them some weightage. Now there are certain way to calculate the weightage. The first, the weight based on the book value of the capital, correct, and second one is the market value. So weight would be based on two things, on the book value and the market value. So these clause will be given in questions, so according to questions you have to adopt it. And we take one numerical also to understand this in better way. So both of the above together is called the historical weight method of calculating the weight. Example, from the following capital structure, calculate the overall cost of capital by book value method and market value method. So in questions, all different component of cost are given, like KE 14%, KR means cost of retained earning 13%, KP cost of preference share 10%, and KD cost of debt is 5%. And these are the sources. So market value, book value and the market value both are given here, like for equity shares capital, book value 45,000, market value 90,000, retain earning 15,000, and preference share 10,000, 10,000, debenture 30,000 and 30,000. Now we'll move to solve this numerical. The first steps, now we are calculating on the basis of book value method, and the market value method you calculate it by yourself. So the first, they calculate the weight of different component and then multiply these weight with after tax cost of capital and add all the get the weight average of cost. Suppose in this table, the first, the equity share capital, so it is of 45,000, and if we calculate all sort of these sources including equity, retain, preference and debenture, it would be 1 lakh. So what is the share of equity share capital? So 45,000 divided by 1 lakh, so 0.45% is share is of equity share out of 1. Same for retain earning, 15,000 divided by 1 lakh, so 0.15%, 15% is share of retain earning. Same in case of preference share, 10% and debenture of 10%. If we calculate this, 0.45, 0.15, 0.110 and 0.30, we get 1. So through this way we can give weight to the different component of sources of finance. Further, after cost of capital, it is given in the question 14%, 13%, 10% and 5%. If we multiplied, like in first equity case, 0.45 multiplied by 14%, we get 6.30. Same 0.15 multiplied by 13%, we get 1.95, and so on. So with this we get the weightage average cost of capital 10.75 on the basis of book value method. I hope this session would be worthwhile for you, and thank you very much for your attention, and have a nice day.